You're listening to Market Champions, a podcast on navigating the financial markets. Here's your host, Srivatsan Prakash.
Hey everyone, welcome back to another episode of Market Champions. Today I've got Bob Elliott. Bob is the co-founder, CEO, and CIO at Unlimited Funds. He used to be part of the investment committee at Bridgewater, and he was the head of the research team over there, Ray Dalio's research team, which is amazing. So, Bob Elliott, thank you so much for being on the podcast. It is awesome to have you on.
Thank you so much for having me. Looking forward to it.
Awesome. So, Bob, for some of the listeners who may not know, could you talk a bit about your background? How you got started? You went to Harvard, and then your journey kind of in the finance world kind of started from there. So, could you talk a bit about your background and how you got into the industry and your journey to where you are today?
Yeah, I mean, my background is a little different than many people who are in the finance industry. I was actually a botanist by academic training. When I was in my younger years in high school and then in college, did a lot of work in the space. But over time, sort of realized that being a research scientist wasn't really right for me. Frankly, I enjoyed interacting with people more than sitting in the biological laboratories with running big growth chambers. And I think that combined with the fact that during my college years, got increasingly interested in development-related topics and public health, and really recognizing that macroeconomics is really really intersects all sort of facets of life, particularly when it comes to development and health-related issues. And so I actually went to Bridgewater on the expectation that it would be sort of a short stint where I'd learn a lot about the macroeconomy and then maybe go off and do something else. But over the course of my time there, really fell in love with markets and economies and thinking about macro, and have stuck with it ever since. 20 years later, I'm here talking to you about macro.
There we go. And it's crazy how life takes us in interesting directions. And as you mentioned, macro it's very interesting because macro is kind of the amalgamate of so many different. I mean, you have to know some amount of economics and finance, and then you have to know some amount of game theory, some amount of complexity science, et cetera, et cetera. So there's just kind of this amalgamation of so many different fields of study.
That's exactly right. And I actually think the pure sciences are such a good entry point into at least macro and economics, because pure sciences, like what you're trying to do is you're trying to understand systems and how they intersect with each other. In particular, my research was on plant development and how water transport and nutrient transport systems intersected with environmental conditions. And that in many ways is exactly how the macroeconomy works, in the sense of that there are these somewhat independent dynamics that intersect with each other to create a certain set of outcomes. And so that science training, that rigorousness, both the balance of intuition, experimentation, and observation, frankly, the quantitative approaches were all super relevant skill set, and maybe also really a way of thinking that I think has served me well and sort of given a bit of a different perspective than having learn some curves or something like that in a more traditional academic economic environment.
Absolutely, yeah. It gives you the chance to apply kind of the kind of systems thinking that you learn, studying the pure sciences. And when you were at Bridgewater, what was that experience like? You spend a very long time over there, and Bridgewater is kind of when you read Principles by Ray Dalio, and he talks a lot about the transparency, the importance of culture, and the environment. So I guess working over there, what were kind of the biggest takeaways, your biggest takeaways, the things you learned, etc.
Well, I think certainly I'd say in my first decade there, working closely with Ray, I learned a lot about how to think rigorously about macro, about markets, and about how to develop systematic approaches. And I think I think the couple of key sort of lessons, experiences, skills, maybe you might even say, that I learned was really I say first, this idea of thinking from the big picture all the way down to the practical reality and all the way back up, and having to make sure that those things all intersect with each other very well. I think that's often you'll meet people who might be particularly good at the big picture or particularly good at sort of the details of analysis, and that in order to really understand how things work, you really have to work at all those levels, which is important. Push yourself to work at all those levels. I think the other thing that was really critical to develop a skill set around was this idea of systemization, which, systemization you start to talk about and people's eyes, sort of glaze over and they think you're just talking about a black box scenario. And I think, particularly also as people talk more about AI today, and then that's like even more black boxy and like, what the heck is all this? And I think it was really a great environment to develop an appreciation for the fact that there's a set of tools that are out there, like AI, machine learning, regression, whatever, all these different tools, random forest. There's a bunch of different tools that you can use that are quantitative techniques to help you express an intuitive or fundamental understanding, express and measure intuitive and fundamental understanding. But the way that works, at least as it works for macro, is that the direction has to be from the intuitive understanding to the use of the tools to then the outcomes and then trading markets. It's very important to think in that direction. Too often I see folks who are very deeply skilled in the techniques trying to go back to the intuition, and that doesn't work. And the reason why that is particularly in macro investing is because there isn't enough sample size to be able to really operate in a way where you can sort of use the techniques to infer the understanding, because the techniques, many of these techniques require a level of sample size to build their inferences that is, we've had 7 macro cycles since 1945 or whatever, like that. That's literally 7 data points. 7 data points isn't going to get it done. And so really understanding and appreciating where are those tools effective, many sort of machine learning models are very effective in, say, short-term individual security trading with a time frame of 1 day. That's a very, because you have incredible sample size to infer from there, and incredible ability to bet on a lot of different outcomes, but definitely doesn't work as a solution to certain other problems, like, is the yield curve inversion, does that indicate a recession? And if it does, over what time frame? Like that is not a very good use of those sorts of techniques. So a lot of that, there was a lot of building that suite of understanding and toolkit that I can then apply in a bunch of different ways, as I'm doing what I'm doing now.
So when you say, you go from kind of the intuitive understanding, so would that be, for example, saying, bonds are, are safe, are kind of a safe asset. So therefore, in kind of a bear market, generally speaking, in a bear market, bonds should do well. And then after that, trying to see how bonds behave in a bear market.
Right. That's a simple, I always like to say, well, if inflation expectations rise relative to what people had initially expected, generally bonds will sell off. Yeah. And why is that? Because bonds, the interest rate on bonds is reflective of a combination of what people expect on the real yield plus what they expect to get paid for inflation over time. And so, like, that's a fundamental, that's a sort of a simple fundamental understanding, intuitive understanding of how the world works. And then you can go back and you can say, is that simple intuitive understanding true or not true, right? Is it, does it work that way, in all environments, in some environments, right? And start to build that sort of, and then the question inevitably comes, okay, so I just said that, and you're like, okay, yeah, if inflation is above expectations, bonds sell off, but like, what does that actually mean in terms of how do you go execute that? How do you measure that? How do you figure out what's priced in? Like, this is not a trivial exercise, but it starts with the intuition and then goes in that direction. And I think in particular, this environment has been really important to force people to start with the intuition, and start with the I call this the fundamental intuition, and then have to go and then go and measure those dynamics. And I think, like, yield curve inversion is such a good example. Like, everyone, how many people were like, well, the yield curve's inverted, recession is now. And it's like, hold on. Let's that's a good example of observing and inferring, observing and intuiting, right? Rather than saying, okay, well, let's talk about what are the fundamental drivers, the intuitive fundamental drivers of how the macroeconomy works, and how does the yield curve fit into that? Is it a reflection of the fundamental dynamics? Is it a indicator of what's likely to transpire in certain ways? Is it a reflection of market pricing? Is it a reflection of supply and demand imbalances? Like, all of those things are the fundamentals that you have to understand. You can't just sort of use the indicator and go back and say, well, obviously this is just how it works, is, recession's on the way.
Got it. Yeah, no, that's absolutely key. And, as you mentioned, like, there's kind of like market truths, or like, stuff that's accepted in the market. And then when you look at the data, you're like, is this really that true? Or is it really work? Absolutely. And, I guess, and, kind of on the trading side, is there anything that, you've kind of learned, or you've kind of noticed, especially, Bridgewater is kind of, the biggest hedge fund, versus, now, you're kind of focused on asset allocation for more so retail investors, that unlimited funds. So is there kind of a change in the approach in terms of the way you think about investing, etc., as you've made that transition?
Well, I think the important thing when you're thinking about being an investor too is you're not just like a model builder, right? You have to connect what you're building to actual assets that you're going to go buy and sell. And I think there's a lot of folks who may be in the market are either so focused on the trading the assets that they sort of miss the bigger picture and the dynamics, etc. And there's others that are so focused on the bigger picture. But if you were like, okay, so like go, like, what are you going to trade? Like, literally, how are you going to go get that done? That becomes more of a, that becomes a challenge. And so, I think one of the, at Bridgewater, most of my work was around developing investment strategy, though I was responsible sort of end to end in terms of all the way down to the execution. But I think this has been actually really, my work at Unlimited has been really fun, because it really has been a set of work that started with modeling and intuition and understanding, and then and then picking the right tools to basically apply to the question at hand, which are maybe different from what I was doing before, related, but the actual techniques a little bit different from what I was doing before, all the way down to then, okay, let's figure out the trade execution and execute it, and then put it in an ETF wrapper, and then like, okay, now we've gotten we've done the whole gamut.
Yeah.
And then, of course, all around the fact that I'm trying to basically take what the hedge fund industry is doing, and then reverse engineer how they're positioned, and fast follow it. And so that it's been frankly a fun problem, like a different set of problems or challenges than developing proprietary investment strategy, but one that I think in a lot of ways has been pretty refreshing to me, because it's taken all of this experience and understanding that I developed over 20 years, and it's almost like take all of that and kind of reorganize it in a different way that creates that can create a beneficial financial product.
Got it. No, that's absolutely key. And I think, what you said at the start is very important, because, you see a lot of that, especially on Twitter, where you have kind of a statement, and then you're kind of like, okay, so what is the trade? And you're like, how do I incorporate an investment? Or, for example, you would have someone come in with, China is, I don't know, China, the Chinese economy is collapsing, or, AI is going to be big. And, these kind of very, very abstract statements that don't directly have, a trade that's that's inferred, or a trade that's implicit, and so you kind of have to go from there in order to actually try and figure out, okay, should I sell the Chinese yuan, should I sell Chinese stocks, what is the trade here? And so I think that's very, very important. I think that's very interesting that you mentioned that.
Yeah, and it's part of it's honestly when I'm writing on Twitter, I try my best. I try my best to basically go through that process of connecting it to what the heck I would trade. So, you can read this like long drawn out thread, which, only a small share of people get all the way down to the bottom of. And, and it's like, what I'm trying to do in most of those instances is then connect it to, okay, well then literally, what is the asset? What am I going to, what makes sense? What's mispriced in the world? And I think that, in a lot of ways is a really important, that method, let's say, I think is a really important process. If you just go back to sort of lessons learned in the first 20 years of my career, that I don't think necessarily every investor has in their mind, which is start with what's priced in, think then about what's happening right now and how we got there, then think about what are the couple of things, you don't need everything under the sun, what are the couple of things that are going to change the today in the future, and then compare that future to what's priced into the market to see whether or not there's an investment opportunity, right? But you got to do sort of all of those pieces. You have to make sure that you hold yourself accountable to what's priced in, and you understand that. You have to understand how we got to where we are today. You have to think about what's likely to change in the future, and then you have to see that opportunity of the diff between the two. And that process is the process that creates trades.
Yeah.
Right. The process that creates trades is going through step by step in there, and the outcome is, and therefore this asset or this reality essentially that's priced into asset markets is inconsistent with the probabilistic reality that I think is likely to transpire.
Exactly. Absolutely. I think you're 100% spot on. And I guess, moving on just to kind of the macro environment, you spent quite a bit of time, talking about tight labor markets and, how this kind of matters to inflation. And one thing that's interesting is, so recently Matt Klein, who writes The Overshoot, he came out with a piece on kind of, is it just wage growth that needs to normalize for inflation to come down? And so, the rate of growth in wages has kind of been upward sloping over kind of the last, say, 18 months. And so is that kind of the key variable here, where you could have a tight labor supply, but at the same time, if wages start to come down, or if wage growth starts to normalize quite a bit, we would start to see inflation come down. Is that kind of the way you're thinking about it? Or what are kind of your thoughts on inflation and the labor market here?
Yeah, well, I mean, first of all, when you're thinking about inflation, there's basically there's two things that matter probably more than anything. Again, just going to break it down into some simple, digestible, understandable pieces. Inflation is basically oil, which permeates everything that goes on in the economy. And then the other piece is essentially how much money people are earning relative to how much they're producing, right? Because you think about oil as sort of an inelastic input. Oil comes in, you got to pay for it because you need the energy. And when I say oil, what I mean is you could kind of think more broadly about commodities weighted by the needed demand for the economy or whatever. And so you kind of think about it that way. And when it comes to wages, I describe it in that context of nominal wage growth relative to productivity growth, because I think that's a really important way to think about it, because what that helps you understand is how much are people's pay getting increased on an annual basis relative to how much more are they producing. And so if I think the UK is a good example where wages are growing at almost 8% nominally per year, and then you turn over and you look at productivity and you're like, well, the productivity is zero. Okay, well, so how does that resolve itself? You can't just have more income into the system and no more stuff and expect prices to be the same. Now, of course, part of that excess income relative to productivity growth could flow into financial assets. It could meet or could resolve in greater financial savings, right? And then support financial asset prices. But particularly as you think about that sort of equation for a lower income cohort, right? Those that are primarily not saving meaningful portions of their income, like basically what happens is they earn an income and they spend it, right? And so if you can understand that imbalance between the growth and what they're getting paid and the income that they're and the income and the amount that they're producing, that essentially gives you an indication of what structural inflationary pressures exist in the economy. And this isn't a black and white idea. It's not, and there's all sorts of measurement, ambiguity. So let's not like try and overdo it. But I think this basic idea right now, which is like, look, people's pay is rising pretty fast, faster than it has in a long time. And the efficiency with which people are producing, goods and services is weak relative to history. And so it's not surprising that we're getting this structural inflationary pressure. How does that get resolved? Well, it can get resolved through either productivity improving, which, on a structural basis doesn't really change very fast. Like, even the advent of the personal computer, which is probably the biggest, productivity impulse in the last 50 years, it took kind of like 15 years to matter, to be, meaningful, right? So that's probably not, it's not going to change in the short term. But what can change, or say structural productivity doesn't change in the short term. What can change is basically two things. You can loosen the labor market, which causes wages typically to moderate, right? Because as labor markets loosen, people's wage income you'd expect to slow. The other thing you can do, which is, important, and basically how this gets resolved in most cycles, is a loosening of the labor market typically enhances productivity. And the reason why that is that the people who are hired at last in the cycle and the people who are fired first in the cycle are typically the lowest productivity employees. And that makes sense, right? You try and find the best employees that you can to start. And then over time, you find whoever you can who's still unemployed to come into the labor market. And so that sort of tactically is how, or I'd say cyclically, is how this imbalance gets resolved. And so that's the most likely resolution here, is that, there'll be sufficient slowing of economic activity that will create a moderation in the labor markets that will both improve productivity and also bring wages down. And so that's how it gets resolved.
Got it. And I think it's interesting because when you talk about wages versus productivity, and so you want for a unit increase in wages, you want to see a similar increase in productivity, in which case it actually makes sense for wages to go up. And so if you look at it, theoretically, if you look at what central banks are trying to do, at some point or in some way, they want to see the unemployment rate, tick a little bit higher, just to make sure that, just to keep the labor market in check. And, if you look at, what would happen, I guess, theoretically, it would be someone who gets unemployed, their productivity would go to zero since they don't have a job. But then, they still have to pay rent, they still have to pay for food, etc. And so there's still some amount of spending. So, theoretically, there's going to be some amount of spending with no productivity. And that should, again, in theory, be inflationary. But then, when you look at the relationship between, unemployment and inflation, there's no real clear relationship. And, that's something we observed over the 2010s where, you sort of saw many claims of the Phillips curve is dead come out. And so I guess through your work, what's kind of your take on, the Phillips curve or your take on this relationship between unemployment and inflation and, kind of this higher rate cycle, how do you think this ends?
Well, I think academic economists really want some like elegantly fine-grained theory that is then represented in a precise econometric model. And long ago, I gave up that is a solution to most of the types of dynamics that we see in the macroeconomy. And so I think the interesting thing about say something like the Phillips curve is people will sit there and say, well, it's not playing out precisely as it has in other cycles or whatever. And it's like, yep, totally right. Look at the empirical evidence. It's relatively clear. But that doesn't mean the fundamental cause-effect linkage isn't basically the same. Again, going back to that concept of fundamentals, like if the labor market loosens, the pressure on wages will ease.
Yeah.
Like that is a fundamental that's a fundamental concept. Now, what makes this business more challenging than writing, econometric papers, is that there's a lot of ambiguity, other things, a lot of things going on at the same time. And so you can't just say, okay, well, I'm just going to use the curve from before and, apply the curve to today. And I think even today's like dynamics, like if you thought about employment tightness as a more, in a more comprehensive way, right? I think what you'd say is that there has been a meaningful loosening of employment tightness, today relative to where it was, 18 or 24 months ago, right? And so if you get too hung up on measured unemployment, it will look like the relationship doesn't hold. But if you look at here's a simple example, like, is there such a demand for engineers that they're getting paid, $300,000 bonuses in order to come on? No. Okay. Well, like that's indicative of the fact that the labor market has softened a little bit, right? And that also connects to the fact that, income has moderated a little bit. So I think don't give up on the fundamentals. Think about it less precisely and more comprehensively. And I think you'll find these sort of core intuitions to still be quite viable. It's not viable in the way that an econometric paper points them out.
Got it. And I've also seen you, and you've also kind of talked about how central banks across the world, and the BOC, the BOE, the Fed, the ECB, etc., they've kind of taken this big bet on where they've hiked rates at the fastest rate possible, and what they're trying to do is moderate inflation and try and weaken the labor market. And so if you were a governor of the Fed or the governor of a central bank, what would be your approach to kind of solving the inflation problem that we're seeing right now? Because as you've talked about, it's not exactly black and white where you see inflation, therefore we hike interest rates and therefore inflation comes down, and it's just not been that way, and it's taken a lot longer for inflation to resolve than what most people have been expecting.
Yeah, first of all, I'd say central banks face a pretty challenging circumstance right now because in a lot of ways, the restructuring of economies following the financial crisis have really sort of changed their toolkit and the effectiveness of their toolkit in terms of rate rises and even asset price moves to shifts in demand and nominal incomes, and with it nominal spending and inflation. And so they're positioned, or structurally, like we haven't seen a real down cycle in 15 years because COVID was kind of like a little bit of it was an external shock more than it was a cycle, right? It wasn't really the cycle. It was it was a crisis, a sort of shock situation. And so given it's been 15 years and given the entire economy has basically been restructured since COVID, or since the GFC, that uncertainty means that they don't really necessarily know exactly what they need to do to achieve their goals, right? And I think often people will say, well, I think maybe they're just not achieving, they've given up on their goals, or the Fed is fine with higher inflation, and there's some sort of conspiratorial view that central bankers are trying to like structurally inflate away the debt and fund the government and stuff like that. I don't think that that's right. Like this is more a story of that would suggest that there was planfulness, that there was a design for the challenging outcomes that they've seen. And I think it's more a matter of incompetence, not judgmental incompetence, just like they have not been competent to be able to achieve the goals that they've set forth. And so in that context, I think what we see from a lot of these folks is they've really gone and leaned on the one lever that they feel like they know that's more, been used for 40 years, which is interest rate hikes, only to find those to be like not that effective in getting done what they need to get done. And for a number of fundamental reasons why that is, in terms of restructuring debt in the economy and terming it out and fixed low fixed borrowings and mortgages and by corporations. And the funny thing is that they've sort of stepped away from using a lever that actually proved pretty effective in the 2010s, not perfect, but pretty effective, which was the use of quantitative easing or tightening, which is just the flip side of it. And they've kind of given up, basically everyone has given up on QT as a lever. The Fed really hasn't changed its view on QT in a long time. And that's surprising to me because when I think about, the U.S. economy is too hot, right? Inflation is too high relative to mandate. That's the basic issue. We could quibble about the nuances of that. The price of credit is not really the problem in the U.S. economy. Like, it costs a lot to borrow. They've like pretty radically changed mortgage prices, car loan prices, all that stuff. The problem is that people aren't borrowing at those elevated rates, right? Because they don't have to borrow at those elevated rates because their asset prices are so elevated that they can basically sell assets to buy the things that they want, essentially pay all cash for houses or all cash for cars because asset prices are elevated. And quantitative tightening is the most effective lever to influence asset prices, right? Because all quantitative tightening is selling assets. And so the central bank sells assets that should hurt asset prices. And it should help deal with this problem, which is really not a price of credit problem that's been repriced, but a price of assets problem that continues to keep the economy going at a level and rate that is too hot relative to the mandate.
Got it. Yeah, you've kind of talked about that the kind of disparity between the price of credit versus the price of assets, and I think that's really interesting. And I guess I wanted to use that to segue into kind of the asset allocation side. So considering over the last 10 years, pretty much especially until 2021, there's been kind of a generation of investors, obviously me included, who've never seen high interest rates, high inflation. All we've seen is prosperity, for an extended period of time. And so, all of a sudden now, within the period of a few months, it's all flipped on its head, where now you have high rates, higher inflation, etc. And so, when you think about asset allocation in this kind of an environment, how do you go about approaching that problem? You came out, I think, a couple of days ago with a post on how the role of cash and how you should not be dumping into cash with rates of 5% unless you were a genius market timer, which obviously everyone's a genius market timer, right? So, so how would you approach the asset allocation problem, given the environment that we're facing?
Yeah, I mean, I think we have we have an interesting environment where if you think about it, there's a large generation of folks who basically have only learned that you go YOLO on the highest risk asset. I mean, think about it. If you started investing in March of 2009, which is, where the bottom of the US stock market was, how many months have you experienced, meaningful declines in equity prices? In the span of 15 years, you've experienced probably one collective year, right? Because COVID reversed basically instantaneously. It's 20 days. And 2022 felt so painful, but I mean, it was really just kind of January to October. That's not actually that long a time frame, right? And so so I think a lot of folks sit there and look at it and basically say, well, look, why would I do anything other than basically go all in on stocks? Because that's what I've learned. And I think it's important to recognize just how unusual this environment was. The massive monetary creation that we saw post financial crisis in order to create, a moderately growing economy is not necessarily something that will persist forever, nor will the secular and global in nature disinflationary forces that basically existed for the last 20 or 30 years before COVID exist for forever either. And so, I think for a lot of folks, the question, they sort of, there are a lot of folks who are still YOLO stocks and I can't really convince them otherwise. Maybe try and show them the fact that, stocks can in real drawdowns for 20 years. And that's happened, a fair amount, but, maybe you can't convince those folks, but for folks who sort of recognize that this time this period may be different from what they experienced. I think a lot of folks' initial inclination is go to cash, right? Because cash will be a better, cash, you don't have a yield penalty. It's yielding 5.5%, like not a bad deal. I think the challenge with that is that, or that is a solution, but I just think it's not a great solution when you have the alternative solution of buying a well-diversified portfolio of assets to invest in. And the reason why that is like, look, cash over very short periods outperforms assets, can outperform assets as the central bank's trying to tighten aggressively. But, in the vast majority of instances, financial assets outperform cash, and there's a fundamental reason why that is because why would you ever invest in financial assets if you didn't get a return above a risk-free asset like cash? And so, it comes down to the fact that in general, assets outperform cash, and so you really don't want to be overweight cash because it, because that will create return drag on you over time. The real question is, how do you construct your asset portfolio to make it as balanced as possible, to make sure that you have some indifference, right? You're not swayed by one particular market environment. Those who are YOLO stocks, basically are looking for low inflationary environments with very strong growth. And the reality is there's lots of other environments that happen: stagflation, depression. You can have deflation, disinflationary booms. You can have disinflationary busts. You can have all of these sorts of dynamics that occur. And so much better just try and create a diversified portfolio to protect yourself against that. And I think in particular, recognizing that the real risk of ruin for investors is not bad growth. That's not a problem, right? You can buy bonds, you can buy other assets that perform well during weak growth environments. The real risk of ruin for an investor is an elevated inflationary environment when they're holding disinflation-oriented assets. That's the risk of ruin. That's what happened in the 70s and 60s for many investors, right? Created huge losses of wealth. And so that's really what people have to protect themselves against. And the funny thing is, because we've had, 40 years of disinflation, it's the exact thing that people are not protecting themselves against.
Yep. No, it's absolutely true. And one thing that you've touched up on is on Twitter you kind of see the two extremes of this. So when it comes to the role of gold in an investment portfolio, you kind of see the two extremes where you have the one camp, which is the gold bugs, where they're all about the 5,000-year history and how you should have 100% allocation to gold and store in a vault in Switzerland. And then on the other side, you have kind of the MMT guys who say gold is worthless and it's kind of a currency of the past. It's just a shiny pet rock. It's got no value. And you kind of take a more sensible approach. So I wanted to kind of get your thoughts on gold and kind of what kind of role does gold play in an investment portfolio?
Yeah, well, I think, gold's role, and the first thing I'd say is gold, we've gotten, 5,000 years of history in terms of, the role of gold, or to see and understand how gold functions as a financial asset. And I think that's an important thing because, gold is different from extractive commodities, which have like productive value, or stocks or bonds that have a clear reason why they would have yield over time, right? So somewhat of a fundamental valuation that can be thought of relative to the cash flows that they'll produce. Gold's different, of course, because it has de minimis industrial value and also offers no yield. So you put that together, and that's a very interesting asset. And so you do have to understand it in the context, like how gold works and how gold functions and performs as a financial asset is a matter of psychology. Like, that's very interesting. Like, a very interesting thing to think about, that it is a matter of psychology. Like, it's not a matter of fundamentals, it's a matter of psychology. So you have to understand the psychology, and the psychology basically holds in a couple different ways. First of all, gold serves as a contracurrency. And what I mean by that is that, paper currency has a certain value that's expected over time, and gold is a contra to that, in the sense of it is an alternative currency that you can hold your assets in, that is widely accepted in the sense of everyone in the world people buy gold in all sorts of different ways, and has been accepted throughout history. And so whenever you're thinking about gold, it's important to think about it like, I can either choose yielding paper currency, right? Or I can choose non-yielding gold. And what you see is in times when people start to raise questions about the value of paper currency, you often see gold outperform paper currency. And the other thing is, at times when you see interest rates rise on paper currency, you typically see gold underperform.
Yep.
Right? Because one has yield and one doesn't. And that's just a natural trade-off. And so I think you want to think about it with those fundamental dynamics. And in that context, it allows you to start to think about, okay, what are the circumstances, the outlier circumstances, the unusual circumstances where you'd expect to see gold do well? And that's, places where you have to have meaningful currency devaluations. Like, interesting in China today, just as a simple example, in an environment where there's meaningful capital controls, right? What are they doing? They're going to buy gold, and gold's trading at like an 8% premium in Shanghai over what its price is in London. That's in that, it may be a pet rock, but it's a pet rock that all of humanity across cultures has largely identified as being the pet rock you want when you want to be able to store, have a storehold of wealth.
Yeah.
And so that's a good example. There's also a situation where, let's say you think that there's a risk of a meaningful easing of monetary policy, an unreasonable easing of monetary policy, let's say, because, let's say central banks haven't beaten back the inflation dynamic, even though they're starting to shift their interest rate policy. That could be a good time for gold, because it's a circumstance where the value of paper money versus stuff is starting to get depreciated. And you see a circumstance where yields are starting to compress. Those two things set themselves up for actually quite a good circumstance for gold. And so you want to think about it from those fundamental perspectives. And I think what you'll find if you look through time is that gold is a pretty good diversifying asset in a lot of circumstances. As a simple example, if you go back and look through time in terms of like rolling 12-month periods where U.S. equities have been down over the last 75 years, gold has outperformed bonds in more than 50% of those circumstances.
Yeah.
Okay, well, and then you just compare that and you just say, that's empirical evidence, and I could go show that to you across developed countries. I could show you across emerging countries. It's a little better for emerging countries because of the contra currency stuff. But you put that all together, and then you say, okay, so how much gold do you have in your portfolio? And someone's like, no, none, because you'd be a crazy person to hold gold, because only weirdos hold gold. And I'm sitting there going, like, what? I'm no, living in a bunker gold bug. I'm just looking at the empirical evidence, and I'm like, well, this seems as good as a diversifier as bonds are. So like, maybe I should just kind of hold them in an equal weight. But yet that's like a radical difference. Like, everyone in the world is overweight bonds, and basically no one holds gold. Even though the empirical evidence would suggest that there's like very good reason why you'd want to hold gold over long time frames.
Absolutely. No, absolutely. And it's kind of like gold plays the role of insurance in your portfolio, especially as a retail investor. You kind of have access to gold, and, as you mentioned, it's kind of the contra currency. It does well in times of distress, and when there are times of distress, as you mentioned, you should have you have that trade-off between a non-yielding asset versus right now where you see cash yielding say 5%, and so that becomes a very obvious trade-off that you get to think about.
And it works out that if you first of all, I always like to ask the question, like, what assets perform better, let's say since 2000, gold or stocks? The answer is gold. What assets performs better since 2010, gold or stocks? Well, actually, it's gold. Like, how many of these things do you have to how many times do you have to over all these time frames? What about since the beginning of the tightening cycle, like gold or bonds? Oh, actually, gold has meaningfully outperformed bonds since January 2022. Like, what about since the beginning of the year? Like, just like go through all of these different circumstances, and what you see is, like, frankly, there's some like bizarre blockage, right, in terms of people's thinking about the value of gold and the role of gold in a portfolio, that like just open your mind to the empirical evidence that gold could be a beneficial asset to your portfolio. And I'm not saying go invest, all your money in bars in the Perth Mint or something like that. I'm saying like buy, put 10% of your portfolio in gold. Like you'll likely be happy for it.
Yeah.
That's not a bit, and you get most of the diversification benefit from just that 10% allocation.
Yeah, no, exactly. And yeah, and as you mentioned, yeah, don't buy 100% gold and then, go live in a bunker in, northern Canada. Um,
Or maybe you want to, but it, should have nothing to do with your asset allocation preference and more for your desired preference to interact with other people.
or not interact with other people.
That's right. That's right.
Yep, absolutely. And I wanted to move and talk a bit about kind of the hedge fund landscape and say, another thing that you've been pretty vocal about is I quote one of your tweets where you say, manager's track record built during a period of zero interest rates with much smaller AUM is unlikely to be indicative of performance during a period of elevated rates and much larger AUM. And you've kind of also highlighted kind of the dispersion where you could for example in 2022 a lot of macro strategies did very, very well, and then in 2023 they're not doing as well, and over kind of the 2010s they were kind of so and so, some of them did well, some of them did not do too well, and you kind of have this big dispersion in returns, especially on the public market side. And so kind of the hedge fund industry, say in the 1990s, was where you could have two guys in a basement with the Bloomberg terminal, and you could run a hedge fund that way, and it's kind of evolved into where now you have the giants, you have the Millenniums, the Bridgewaters, the Brevin Howards, etc. And with almost and the smaller funds, they tend to suffer. So the hedge fund industry has kind of evolved, and so what are your thoughts on that, and kind of how how it's changed, how it's evolved, and where that kind of alternative investment industry is headed from here.
Well, I think there's in some ways the industry has changed a lot in the last 20 or 30 years, certainly since I started getting involved in it, and in some ways it hasn't changed that much, and the reason why I say that is that the big picture is that that fund managers almost always sort of have a set of a strategy, right? An alpha edge of some form, and that's all really the strategy is a way to gain durable alpha edge.
Yeah.
And that what they're trying to do is come in and day out, like execute that strategy in the most disciplined, effective way possible to get the most out of their edge. And the nature of these strategies, which I'll call alphas, they're all different, slightly different, but that they're kind of knowable in the sense of if you, for instance, were to look at the index of the average manager return or the median manager return, what you see is that those alphas, those strategies, have certain properties. There are certain ones of those alphas that do better in early cycle environments and some better in late cycle environments, or certain ones that are better in monetary easing environments and others in monetary tightening or elevating volatility and falling volatility. Because in a lot of ways, those strategies are just they're ways to reap the benefits of irrational behavior by other folks in the market, and that irrationality emerges at different points under different conditions. And I think one of the challenges, there's really two challenges that exist in the hedge fund space for any investor, which is the first is the single manager problem, which is, well, I've sort of described that there are these hedge fund strategies and they have alphas and those alphas have properties. The reality is any individual manager is like kind of taking that core idea and then adding their own flavor on it, which, to be frank, mostly adds randomness, right? That in general, managers don't show actually much outperformance persistence. Like the likelihood that a manager outperforms over the span of 5 years is above median over the each of 5 years is equivalent to randomly selecting managers, right? So it's there really isn't that much manager outperformance persistence, and so sort of that incremental alpha, individual manager alpha relative to the strategy alpha isn't that good. And so you're kind of better off actually looking at the strategy alphas, not the individual manager alphas, if you're trying to think about how do you do that in the most efficient way possible. The other thing that I'd say is that allocators are stuck with this core problem of a lack of agility, right? So if you're an allocator and you go invest in a fund, like what are the odds that you redeem that fund, in a month or 2 months or 3 months or 5 years or 10 years, right? I mean, the decision-making process around the allocation of these funds is incredibly slow moving. And so I think what that does is it means that there's certain strategies, going back to what I just said before, there's certain strategies you almost know are not going to go well during a period of time, right? You're like, oh, well, I bet my equity long short managers are going to get really squeezed right now during this period of rising equity volatility.
Absolutely.
And then what do? Well, I don't know. You go home and have a beer and hope that it's okay, because you can't agilely move between the different strategies. And so that kind of stuck situation means that, from an allocator's perspective, there's not really much benefit from trying to pick which strategy is going to outperform which other one, because you're just going to get stuck in essentially all the strategies at some point. And so I think those are sort of the two core issues that we haven't been able as an industry really to meaningfully overcome those core issues, which is get away from individual managers because there's too much randomness relative to value, and get away from basically totally illiquid structural positions that force you to be in stuff that you'd prefer not to be. Very different from equity investing or bond investing, where there's indexes all over the place and where you can be highly agile in how you allocate your capital.
Absolutely. And on that note of agility, I'm sitting here in Toronto, kind of the home of the Ontario teachers and the Canada pension plans, kind of the large some of the large institutional investors. And what I've noticed is, with these large institutional investors, they've kind of shifted to kind of slimming down, their exposure to public markets, and sort of shifted over to being more exposed to private markets, where you get to kind of hide your true risk-adjusted returns, below years of illiquidity and return smoothing. Where that's kind of notable because in the private equity and the private side is typically depended on 40 years of lower rates year after year after year, and debt that's borrowed on those lower rates. And now that over the last 18 to 24 months we've observed interest rates go up, they're kind of in a pickle right now. So I guess on that note, do you have any thoughts on kind of this emergence of kind of the liquid private side, and how institutions have kind of shifted towards, or have been more biased towards, the private side?
Well, the first thing I can confidently say is that the emergence of these private fund strategies have made the managers rich.
Yeah.
Right?
Yeah.
And then you think about that and you say, well, if the managers are rich, who's getting poorer? And the answer is the investors are getting poorer. And the reason why that is, the investors are worse off as a function of these strategies. And the reason why that is that the private fund managers are essentially offering a return smoothing vehicle, sometimes with leverage, sometimes with just higher volatility. And what they're doing is they're charging 700 basis points a year in effective costs to do it. Well, that is a pretty odd approach if you're an asset manager, if you're an allocator, right? Because you can choose to smooth your returns however the heck you want, right? You don't have to, book your S&P 500 exposure on a day-to-day basis. There's no reason why that has to be the case, right? You could book it over a quarter or a year, or you could even think about it for, a lot of these institutional investors, like they're not thinking, their time horizons are 50 or 100 years. Like, why even, you could book it over 10 years, right? What's going on with that? But instead, they're being fooled by the package, right? And thinking that package is beneficial. And the reality is it's at the detriment. It's at the detriment of their stakeholders, the huge detriment to their stakeholders. I think the thing that's interesting is if you, for instance, let's say instead of looking at venture capital returns on a quarterly basis, which is a silly way to look at it, of course, because you can't get your money out on a quarterly basis, right? You give your money and you get some payments over the course of, between 5 and 15 years, right?
Yeah.
So if instead you were to account for it on let's say a 10-year average, let's just say, like you just said, I 10-year smooth my 60-40 portfolio, and I 10-year smooth my venture capital returns, right? Which is essentially how it works out. What you'd find is that venture capital outcomes are actually a net drag on the Sharpe ratio of portfolios, right? When you actually do the proper accounting matching, right, they're a net drag on the portfolios. And the core reason why that is because of the fees, because they're charging such egregious fees for what they're doing to give you returns that, basically you could have gotten otherwise in lots of other different ways. And so I think that's at the core, that's fine. Like if someone wants to return smooth or whatever, like, no grudge against them. That's not the problem that I have with it. The problem I have with it is that, the managers are getting rich off the backs of, the teacher's pension.
Yeah. Yep, absolutely. And that's something you've worked to democratize that unlimited funds. And so I wanted to wrap up the podcast on kind of that note. Could you tell our listeners who may not know what unlimited does? Could you talk a bit about what the mission is there and what you guys are doing, because it's very, very cool.
Yeah. Well, I think one of the thoughts or the basic idea that I had, having sort of sat in the manager seat of the 2 and 20 world for almost 20 years, was basically like, look, 2 and 20 businesses are great for the manager and not that great for the investor. And the reason why that is 2 and 20 businesses are pretty good at generating returns, and they're also pretty good at charging high fees. And you put those two things together, and that's not a great outcome for the investor. And so that kind of got me to thinking about whether there was a way to sort of bring those concepts of low cost indexing and access that obviously have totally changed stock and bond investing. I mean, just radically changed stock and bond investing over the last 50 years. Could we do the same sort of thing in the world of 2 and 20? And that at its core is what we're trying to do at Unlimited, is basically use technology plus our decades of experience having built a lot of these 2 and 20 strategies or invested from that perspective, to basically find combinations of public market securities that do a pretty good job of tracking what those sort of managers are doing, or sort of the return producing. And then of course, because we're using technology, and instead of like having to actually hire all the people to go out and do the deals, or actually create proprietary strategies, then we can offer it at a much lower fee structure. So that's kind of the idea, is these technology enabled approaches to create index replications of 2 and 20 strategies.
Mm-hmm. Got it. Awesome. With that, Bob, thank you so much for being on the podcast. It was amazing to have you on, man.
Yeah, thank you so much for having me. It was great to chat. Hopefully folks find it interesting.
Absolutely.
Probably the private equity folks won't, but there you go.